Folks, you're very welcome to our webinar with our guest, Nora Bosang. My name is David Bosang. I look after all things customer here at Scorebuddy. And as part of our series on webinars relating to financial services, we're going to cover a topic which is close to our hearts in the Irish marketplace, which is customer engagement in financial services, the latest Irish regulatory approach. So I've introduced myself. Nora, would you like to introduce yourself?
Sure, happy to. My name is Nora Bosang. I'm a financial services regulatory solicitor in Ireland. I have a particular interest in conduct of business regulation and in particular in the area of consumer protection.
Excellent. And I would like to say for disclosure, you're also my sister, younger sister. And you literally did write the book on consumer and SME credit law. So there's a high degree of expertise and we're very lucky to have you. So many thanks. What I'm going to do now is I'm going to start sharing some slides because there is a lot of material that we do want to cover with the audience today. Nora, in one of our recent seminars, our colleagues from Mazars gave us some pointers on UK consumer duty. Could you remind us of what that involves?
Certainly, and happy to, David. So the UK consumer duty, a very live issue in the UK geographical area. It's effective for existing products from the 31st of July 2023. And as you will have heard in the last webinar, there's a high level standard to act to deliver good outcomes for retail customers. So that's the overarching standard. And then there's 4 outcomes. One, that communications are made so that customers understand what they're buying. The second one is that products and services are fit for purpose. The third is that customer service meets the needs of retail customers, i.e. they're properly supported. And this will be particularly relevant to the services that Scorebuddy provides its clients. And lastly, and quite significantly, that the price of products and services represents fair value. So there's also those key expected behaviour when dealing with retail customers. They're referred to also as the cross-cutting rules. They consist of avoiding causing foreseeable harm to retail customers, enabling retail customers to pursue their financial objectives, which is quite a high bar, and also acting in good faith towards retail customers.
Yeah, it's an extremely comprehensive piece of work, and Mazars very much felt that the FCA had led the world in relation to this piece of legislation. Do we have an equivalent of UK consumer duty in Ireland?
We don't have a direct equivalent of the duty in Ireland, David, although elements of the duty are quite similar to regulatory rules and expectations that apply here, both in terms of regulated firms and that also will apply down the track to individuals working in regulated firms. Now, one difference is that in Ireland, these rules and regulations are not as prescriptive. So, for example, we don't have a specific fair value outcome here. They're also not currently tidily set out in one place. Just in terms of pricing, as people will be aware, the primary regulator and enforcer of financial services consumer protection rules in Ireland is the Central Bank of Ireland. Now, we'll be also referring to them here as the CBI. And the general position for people to be aware of is that the CBI will intervene on pricing matters only where there's a legal basis to do so, and also where it sees firms engaging in what it regards as unfair, hidden, or discriminatory practices which seek to take advantage of customer vulnerabilities. And as we'll see further down the track, customer vulnerabilities is quite a broad church in that context. There is, however, a certain degree of commonality. So the UK consumer duty, as we've seen and as you would have heard in the last webinar, talks about acting to deliver good outcomes for retail customers and acting in good faith towards them. And the overriding regulatory expectation of the CBI in Ireland is similar. So it requires regulated firms to act in the best interests of consumers to seek to achieve positive outcomes for them.
Yeah, and those are two key phrases that we'll be returning to. But before we dive into best interests and positive outcomes, can you talk us through what we are going to cover today?
Certainly, happy to. So we'll first of all be talking about those two concepts as they apply, acting in the best interest of consumers to seek to achieve positive outcomes. So at the outset, we'll be talking more generally around high-level themes as they relate to customer engagement. And then we'll be discussing specific regulatory rules and expectations around more specific customer engagement topics. So we'll be talking about the way information is provided to customers, both on paper and through other online means. This concept of the introduction of positive friction into the online customer journey, which is becoming more of a live issue, while at the same time not establishing unreasonable barriers, i.e. what are regarded as sludge practices, to deter a customer from taking a decision or performing an action that might ultimately lead to the customer's benefit. We'll be talking about something very close to your hearts: regulatory engagement, regulatory expectations around customer support, including online customer support, dealing with complaints and errors. Another issue which is very live at the moment is regulatory expectations around dealing with consumers in vulnerable circumstances, the identification of that and responding appropriately to it, the relationship of all of this with QA, quality assurance, and also regulatory developments around the use of AI. Along the way, I'll be referring to Irish regulatory guidance, and also where it's relevant and helpful, I'll be referring to UK regulatory guidance from the Financial Conduct Authority, which is the FCA. Now, it's fair to say that at present, there's more guidance that has issued from the FCA to regulated firms around their expectations. There's a lot there, in particular around the consumer duty, but there is other guidance too. And we can expect to see more guidance issuing from the central bank, which I think will be a welcome development for regulated firms. And that will be around its revision of the Consumer Protection Code, which I'll be referring to later. Also to say that it is not the purpose of this webinar to critique the approach of the central bank. And also, much to your relief, I am sure, I will not be providing a legal analysis of the requirements. I'll just be giving you information as to the areas of current regulatory focus in the context of dealing with customers. And as you'll see, there's a lot going on.
Yes, thanks, Nora, for clarifying that. We're going to hold off on the legal analysis and release it for the Christmas market. It should be a good seller. For follow on from your excellent book. Okay, you've mentioned positive outcomes, which is a real key phrase we will want to return to. And as you say, it chimes with the UK consumer duty principle to act to deliver good outcomes. What have the central bank said about outcomes when regulated firms are engaging with customers?
Okay, well, they've said an increasing amount as it happens. It's a really central principle. So, for example, when consulting about the individual accountability framework, which we won't be touching on today, but which is coming down the track in terms of certain individuals working within regulated firms, the central bank has said that the core of financial regulation is about supporting positive outcomes. So that's a big statement. Similar to the UK, that puts the general theme of achieving positive outcomes front and centre in the financial services regulatory landscape in Ireland. So what we're not seeing is a narrow focus on ticking the box, tick box compliance, taking an excessively legalistic approach. What we're looking at is achieving a holistic good outcome for the customer.
So there's a specific point I want to make at this point in relation to what currently applies to a firm rather than individuals working within the firm. So Nora, is there a central guiding code in place with which regulated firms must comply when engaging with customers and seeking to support positive outcomes? If so, what are the key principles that must be adhered to?
Okay, well, yes, there is. And I guess if there's one takeaway that I'd like you to have in terms of this webinar, It's the importance of that code and also the significance of the general principles of the code, which I'll come on to. So yes, the overarching regulatory requirements for firms when they're providing regulated services to their customers, and some requirements applied to consumers, which I'll come on to define in Ireland, is the Consumer Protection Code. It's a domestic code. It's not EU derived, although some of the concepts that are in it are draw on EU concepts. It's also a cross-sectoral code, so that's very important to be aware of. So it applies across the gamut to lending, corporate lending, mortgage lending, personal lending, e-money issuance, providing payment services, so it applies to regulated fintechs, a debt management business, insurance business, hire purchase. Just to be aware, and a theme of this webinar is things are always changing in financial services regulatory law, and that's what makes it so interesting. So there's a current review of the Central Bank's Consumer Protection Code ongoing at the moment. There was one, the initial code was issued in 2006. A revised code was issued in 2012, and there have been a number of amendments of that code that have happened on a piecemeal basis since then. But what they're doing is they're undertaking a substantive review of the entire code, and the revisions will be issued by way of regulations, and it's to be a two-stage process. So next year, a revised version will be issued, and then the following year in 2025, a further version will issue reflecting the further CBI policy work and the recommendations of the Retail Banking Review, which the government has announced is to be adopted as government policy. And just to note first off as well, there are some exclusions from the application of the code. It is cross-sectoral, but in terms of specific exclusions, MiFID firms are not within scope. So MiFID firms carrying out investment business are generally out of scope. Also, certain provisions of the code have been excluded or amended for particular sectoral areas to take account of EU regulations. So, for example, if you're an e-money issuer or you provide payment services, some of the provisions of the code have been amended or disapplied, also in relation to consumer credit and other areas. So going on to the application of the code, the general principles, which I've already sort of highlighted, is very important. They apply to customers, and the more detailed requirements apply to consumers, which is a more limited category.
Yep.
So in terms of the general principles, just to be aware, general principles could be argued to sound a bit vague, but they are not just nice to have. They provide fertile ground for enforcement in Ireland. So, for example, in the context of the tracker mortgage examination, one bank was fined in excess of 100 million in the context of breaches of the Consumer Protection Code primarily, and another bank was fined 83 million for breaches of, and generally those breaches constituted breaches of the general principles. So there's 12 general principles in all.
Excellent. And it's hard to classify something as being vague when fines of 83 million and 100 million can result. So before we come back to the topic of vagueness, because they're clearly not vague, when do the general principles apply?
Okay, they're imposed on regulated firms where they deal with customers, i.e. where regulated firms are dealing with customers when carrying on regulated activities in Ireland. Now, customers are all individuals, unincorporated entities, so certain classes of partnerships, and corporates in the state. So I've talked about their application to regulated activities. So if a regulated firm is carrying on unregulated activities, as matters currently stand, the code does not apply. So currently, lending by non-banks to corporates is an unregulated activity. So the code would not apply in those circumstances. But just to say, a recommendation of the Retail Banking Review may well change that. In terms of, we talked earlier about not taking an overly legalistic approach or not ignoring them. Just to say, one of the general principles of the CPC is that firms must have and employ effectively resources, policies, procedures, systems and controls, including compliance checks and staff training necessary for compliance with the CPC. So it's no excuse for a regulated firm to say we're not resourced to do this. That in itself is a breach of the code. And also to say that another of the general principles of the code is requiring regulated firms to comply with the spirit of the requirements as well as the actual text.
Okay, and that's quite detailed and specific. So I understand that one of the themes of the Consumer Protection Code is acting in the best interest of customers. Could it be argued that that is a vague statement?
Absolutely. Well, first of all, you're right. A primary theme in the general principles is acting in the best interest of customers. That's similar enough to the UK Consumer Duty behavioural cross-cutting rule around requiring firms to act in good faith. So the stated regulatory expectation in Ireland is that acting in the best interest of customers is put at the centre of a firm's product offering. So it's absolutely key. Acting in the customer's best interest has been the subject of some debate within the Irish financial services industry. It has been argued with some force that the requirement is too high level and amorphous. It could be interpreted as meaning that a firm has to subordinate its own interest to those of its customers. And it's also been suggested that acting in the best interests of a customer could be interpreted as meaning that the central bank requires a paternalistic approach to be taken towards customers, or a firm being required to take decisions for them. And the latest state of play is that the CBI will give guidance on the topic when it issues a revision of its first revision of the CPC in 2024, which it's currently working on.
Excellent. So do we have any ideas about what the Central Bank of Ireland guidance on best interests will say?
Sure, yes. Based on what it's said so far, including recently in its discussion paper on the CPC, which issued late last year, the likely regulatory focus will be on themes such as you, as a regulated firm, must look at the relationship through the lens of your customer, as well as from the perspective of your firm's owners. So you should hold both interests in balance and have a business model and practices that are centered on the consumer's best interests. And an example given by the central bank of poor culture and conduct would be putting the financial interests of the firm, and by extension shareholders, above the interests of your customers.
And Nor, that's a really high bar. Don't companies owe duty to their shareholders also?
Yes, David, you're right. That is a live issue. There has been a concern that these requirements impose unreasonable expectations on firms who have their own shareholders to account to. So just before anyone gets too worried about unreasonable regulatory expectations, to be clear, this does not mean that you can't make commercial decisions in the interests of your firm and shareholders. And you're right, you owe legal duties to them in any event. You, as a regulated firm, must, of course, do so. But the regulatory view is that you cannot seek to generate inappropriate gains or commercial advantages by leveraging customer vulnerabilities. And this can be quite a broad church in this context. So, for example, the regulator views as vulnerable in this context a customer who doesn't hold sufficient information about the product in comparison with the information held by the firm. Now, that's known as information asymmetries. Also, you can't seek to take advantage of perceived customer behaviors or habits such as inertia. So again, we're back to this concept of the best interest requirement being a holistic requirement. Doesn't involve tick box compliance with the rules. And the questions you should be asking yourself as a regulated firm is, are you furthering the interests of your customers? Does your business model target a sustainable return on capital over an appropriate time horizon?
Mm.
So more specifically, and perhaps more helpfully, in looking at customer outcomes that are in the best interest of customers, the central bank view is that a key question that you as a regulated firm should ask yourself is, what is the customer's legitimate expectation? What would an ordinary time-constrained consumer reasonably have understood would be provided by this product or service? And to borrow from FCA guidance on the consumer duty, in assessing outcomes, your focus should be on how customers actually behave and transact in the real world, and how to better enable them to access and absorb relevant information.
Yeah, and you've mentioned providing information there. Is there a general principle of the Consumer Protection Code which is relevant to communications with customers?
Yes, so again, we're back to the general principles, the centrality of those principles in terms of regulatory expectations. So one of the general principles of the CPC, the Consumer Protection Code, it prohibits regulation firms from misleading customers either recklessly, negligently, or deliberately. And it requires them to make full disclosure of all relevant material information, including all charges, in a way that seeks to inform the customer.
Yeah, and that's very specific. So, what are the Irish regulatory expectations around communicating with customers so as to deliver positive customer outcomes?
Okay, so we saw there in the general principle that making disclosure of all relevant material information in a way that seeks to inform the customer. So the central bank is really focused on effectively informing customers. The emphasis is less on providing information and more about seeking to support understanding. So we will have seen that UK consumer duty outcome, that there's clear and transparent communications so that consumers understand what they're committing to. And interestingly, there's a role for behavioural science here in terms of identifying what measures can be taken to support effective understanding on the part of customers. So a recent study was completed by the CCPC and the ESRI in conjunction with the Bank of Ireland. And what that showed was the positive impact of behavioural insights to customers' saving habits when those insights were incorporated into both the design of the product and also the marketing materials. So that's interesting.
Well, it's excellent and quite innovative to bring
Mm,
behavioral science into this
mm,
framework. Um,
mm.
do you have practical guidance as to written communications with customers that would be aligned with regulatory expectations?
Absolutely. And a lot of these would emanate from when there are settlements with regulated firms arising from enforcement actions. What happens is a statement is issued by the Central Bank of Ireland, and they're really interesting for regulatory firms to read, because what they set out is what not to do in the context of not breaching the Consumer Protection Code. So a lot of these are drawn from what may have arisen in the context of various settlements that the central bank might have made, particularly in the context of the tracker mortgage examination. So what we're seeing here is a key theme of no surprises. So we've talked about regulated firms saying, what would an ordinary time-constrained consumer reasonably have understood would be provided by the product or service? So in terms of practical guidance, in written communications, don't obscure key terms. So key terms around issues such as interest rate changes, amounts payable at trigger points, barriers on exiting the product or service. So don't obscure them in the fine print of the T's and C's. Don't use unclear terms in communications, for example, customer service scripts or T's and C's, and then seek to rely on them to the consumer's detriment. If the terms you use are unclear, then it's likely that any ambiguity will actually be interpreted in the favour of the consumer, not in the favour of the regulated firm. And this was very clear in the context of the tracker mortgage issues. And the central bank has recently highlighted feedback that it's got to the effect that in the hire purchase PCP, personal contract plan relating to cars, and BNPL, the buy now pay later market, there is an absence of or a suggested absence of clarity in the terms and conditions relating to those areas concerning also disclosure of fees and charges and late payment penalties. So another issue is don't overload the customer with reams of small font information so they can't identify the salient points. And a point may be made here, and has been robustly made by regulated firms, that to some extent this isn't really on the regulated firm, because there are so many rules and regulations around the disclosure of information, including under EU-derived regulations, and some of those are actually contradictory and overlapping, so that doesn't help. Also, don't have scripted anodyne responses to complaints which don't solve the issue.
Yeah, there's a lot to reflect upon in relation to written communications with customers, because we see across our customer base a move from voice to obviously written, chat, text, WhatsApp communications with customers. It really does span across multitude, like beyond letters or emails. So I think it's very clear to see the detail within this and the guidance.
Yeah, and highlighting the need for training as well in
Very
terms of
much so.
frontline personnel.
Yeah, absolutely. And beyond that, what about the regulatory expectations where information is provided online?
Right, okay. So the regulatory expectation as outlined at the moment from the CBI is that key information is made accessible and understandable to the consumer in the digital journey. So note there, key information. So issues around interest rate changes, or issues around any barriers to exiting the product. And also that technology-based solutions should enable information to be effectively provided on a user-friendly basis. Again, that concept of effective provision. So the theme here is providing key information up front and seeking to ensure that that information is effectively received and absorbed by the consumer. And there's very likely to be specific regulatory developments on that front in Ireland.
So moving on to other regulatory expectations for online business with consumers, where there's no face-to-face touch point. What are the live points of regulatory debate and expectations?
Well, this is a fascinating issue, David, because what we see here is a tension between what the general business desire is and what the regulatory expectation is. And I guess that's a constant theme in terms of regulatory engagement in any sphere. So what you have on the business front is a general desire to have an entirely frictionless, optimized customer journey. So what businesses don't want is they don't want clunky, complicated, or what might be viewed as unnecessary steps. And what might be viewed as counterintuitive from a business perspective is a regulatory preference for the introduction of speed bumps, precisely so there is some friction in the consumer journey. So we would have seen a 2019 European Commission report around digital marketing and distance selling, which the Central Bank has referred to in its recent discussion paper on the CPC. And the European Commission referred to measures to embed positive friction, which the Central Bank has itself referred to, including immediately before concluding a binding online agreement for a financial product or service, saying to the customer specifically, take some time out before you consider this transaction. Preventing the use of pre-ticked boxes so that the consumer is not being nudged in a predetermined direction, and ensuring that the contract can't be concluded until the consumer has actively and fully scrolled through key information. So this is with the aim of seeking to ensure that customers can fully appreciate and understand the key information that is relevant to their commitment. So it's not a question of just scrolling down through the terms and conditions, which we all do, and pressing accept. It's around identifying on the part of the regulated firm what are the key pieces of information that the customer needs to know here before the customer accepts the deal.
Well, this is just to pause at this moment and reflect about what we're speaking about here is where there's no face-to-face interaction. This is exclusively online, and we've all seen the advertisements for products online where they say sequence has been shortened. I found the concept of speed bumps and deliberate positive friction fascinating, that it would be built into the engagement between the organization and the consumer, because it is vital sometimes to slow the customer down. And here you can see that the regulatory expectation is specifically to slow the customer down, and that can be counterintuitive to what the business wants to achieve, but it
Completely.
is in the best interests of the consumer.
Yeah.
Just moving on, is there consensus between the EU and the UK regulators on these points?
There very much seems to be, and the recent guidance issued by the FCA on the consumer duty also refers to this point. So it's very interesting. What they talk about is that the commercial and marketing teams of firms, they can be overly focused on how many clicks were required to purchase the product, how long does it take, how many dropouts are we seeing, and the regulatory view is that this can lead to excessively streamlining of process to ensure a high conversion rate. And it can risk consumers purchasing products that they either don't fully understand or aren't right for them because they haven't either been given the appropriate, and again, we're seeing that sort of focus on key information. They haven't been given the key information they need, or they haven't been allowed enough time to make a decision before they've actually done that.
So how are firms expected to deal with this?
Right. And again, we're back to this concept of positive friction
Mm.
and the UK consumer duty guidance. So, interestingly, the UK consumer duty rules actually specifically require regulated firms to introduce appropriate positive friction in customer journeys. What they're saying is you've got to mitigate the risk of harm here. You've got to give customers sufficient opportunity to understand and assess their options, including any risks. But they're also careful to say what you're doing here must not create an unreasonable barrier to retail customers. So we don't want to see sludge practices here. We don't want to deter a customer from taking a decision that may ultimately operate to the customer's benefit, such as making a complaint or switching or exiting the product. So what they don't want to see is the imposition of conditions that are unreasonable, that are time consuming, that are too complex for a retail customer to carry out or understand. And it will be interesting in the context of the revision of the CPC and associated guidance to see the extent to which the CBI imposes similar rules, but they don't seem to be too far away from this.
Yep, noted. A topic close to many of the colleagues who will be observing this video,
Mm,
a topic close to their heart is customer support.
mm.
So customer support monitoring is clearly key to those regulatory expectations and rules. Do we have examples of what customer support would not be in line with what the regulator wants?
Sure. Okay. Well, first off, just bearing in mind the FCA guidance concerning the UK consumer duty.
Mm,
So I said I'd refer to this where it's relevant or helpful, and I think
mm,
these questions are. So what they say is the question that you as a regulated firm should be asking yourself is, are you applying the same standards and focus on delivering good outcomes as you are to sales and revenue generating activities? Is the quality of your post-sales support as good as your pre-sales support? So then coming to your specific question, David,
mm.
UK regulatory guidance as to customer support that wouldn't meet regulatory expectations. They talk about consistently poor or excessively slow service. Now, this is a general, it's not just online guide and online support. Channels of support, including support that doesn't meet the needs of customers. So, for example, you might have customers with characteristics of vulnerability, which the channels of support don't support, or the channels of support can't deal with non-standard issues. So there's no exceptions process in place for a non-standard issue where it's presented. Also under-resourced customer helplines. And again, what we're seeing is a disproportionate focus on pre-sales over after-sales support.
Yeah. Um, have they said anything specifically about the expectation for online customer support?
They have. And again, in terms of FCA guidance, what they've said in the context of the consumer duty is that examples of online support that wouldn't meet regulatory expectations are menus or web chats that are difficult to navigate, badly designed websites, and we're all familiar with them, that might make it difficult for customers to find the key information they need. Again, this reference to key information. Uncertainty about where or how to access support. And again, we've all encountered scenarios where you have, press 1, press 2, press 3, press 4, and it's like, but that doesn't deal with my issue. So where there's nowhere to go on non-standard issues. And even in digital journeys, so exclusively digital journeys, the FCA has highlighted that it is likely that a human interface will be needed in some scenarios, for example, where non-standard issues arise, or in sensitive scenarios. And this is supported by the CBI. It has highlighted feedback that a choice or combination of channels in which products and services are provided or supported, they're best in line with consumer interests.
Yeah, no, there's some, the content that we're covering at the moment is very clear and prescriptive for organizations in relation to how they look after their customers. There is the tricky topic of complaints and errors. Now, naturally, I'd like to state that none of our customers ever have complaints, or they also don't make any errors. So, but it could happen. How are complaints and errors to be handled?
Okay, so first off, there's a general principle, so very important. It requires that firms must correct errors and handle complaints speedily, efficiently, and fairly. So that's the general principle of the Consumer Protection Code. Now, there's more detailed Consumer Protection Code requirements set out in chapters of the code, and they apply to consumers. And that actually is quite broadly drafted. So consumers include all individuals and partnerships, unincorporated partnerships. So individuals, that would include sole traders as well as people acting for personal purposes. Also corporates, so long as their annual turnover on a group or standalone basis does not exceed 3 million in the previous financial year. So that's 3 million euro. So the specific requirements of the chapters of the CPC dealing with complaints and errors handling is that you as a regulated firm must undertake appropriate, now this is a requirement, must undertake appropriate analysis of the patterns of complaints from customers or from consumers. This analysis must be escalated to your compliance risk function and senior management on a regular basis. And you must also investigate whether complaints indicate an isolated issue or a more widespread issue for consumers. And that's in section 1012 of the Consumer Protection Code. There's similar requirements in relation to errors. So you'll find the Consumer Protection Code on the Central Bank website. There's an unofficial consolidated version there, which is helpful. There's been a couple of changes since then, but the bulk of what should be relevant is in that unofficial consolidated version.
Key word here is must. Have they outlined perhaps what a regular basis means?
They haven't, but I mean, I'd be thinking at the outset every 3 months, like that would be reasonable. And you'd have to have your data being tracked on a daily basis, I would imagine.
Yeah, in order to support this. No, it's a key point in terms of the reporting of compliance is as important as the compliance itself.
Well, that's actually something, thanks for mentioning that, David, because in the context, what we see a lot is that firms really do want to do the right thing for their customers, and firms are generally incredibly consumer centered and customer centered. But where they might fall down is they don't actually document, they don't have their compliance universe to the extent that that would comply with regulatory expectations, and they don't have the policies and procedures in place that the regulator would expect to see. And that's really important, as you've identified. If the regulator can't see it, there's a problem.
Yeah. Let's continue on with the topic of managing complaints and errors.
Yeah, sure. So in its discussion paper on the Consumer Protection Code, the central bank expanded on these requirements. So again, we're talking about issues around impact, and also transparency. So where failures or weaknesses are identified in the treatment of one customer or a group of customers, the expectation is an impact assessment must be carried out so that issues are addressed for all customers in a similar position. And the regulatory expectations include where you're receiving consistent complaints about one particular issue, are you looking at the issue root cause? And where you are going out to customers and putting your hand up as to an issue, are you being fully transparent? So what we're seeing is a regulatory expectation, again, to take a holistic view of issues, adopting an outcome-focused approach rather than dealing with issues on a disjointed or blinkered basis. And it requires the tracking of data, pretty similar to what you'd see in the context of the UK Consumer Duty. It's likely to be happening on a BAU business and basis in any event. So you're looking at key customer support points, including when or how resolution of complaints is occurring.
Yeah, it's very prescriptive on these topics. I understand that the treatment of consumers that are viewed as having the characteristics of vulnerability is currently an area of regulatory focus in the financial services space. How are firms recommended to deal with consumers in vulnerable circumstances?
Okay, so first off, vulnerability is a real hotspot in terms of regulatory focus at the moment, and not before time. So in the CPC, there's a requirement in the code that firms must provide those identified as vulnerable with such reasonable arrangements and or assistance that may be necessary to facilitate them in their dealings with the firm. Now, we can expect there to be significant expansion on dealing with vulnerable consumers when the revision to the CPC issues the first one. So it's an area of specific focus in the CPC discussion paper. It calls out issues such as the need for frontline staff to be in a position to recognise and respond to vulnerability, to know when it's appropriate to seek additional support with the firm, being empowered to seek support, being trained in appropriately recording information while respecting the privacy and autonomy of the individual. So practical measures in terms of dealing with these areas, they're not specifically referred to in the discussion paper, but they might include, we've talked before about offering alternative communication channels, providing clear, transparent, jargon-free information, perhaps using infographics, making sure that staff are trained so that they're capable of recognizing and responding to needs where there's clear indications of vulnerability. And what we see in a lot of firms is there's a vulnerability center of excellence, so a champion to which particular concerns can be sent. So it's not just dealt with on an ad hoc basis from supervisor to supervisor. Also, what's very important is a one-stop tell us once approach. So we all know, whether or not it's relevant to characteristics of vulnerability, how frustrating it is to have to retell your story when you're shunted from pillar to post. And that is even more important to ensure that that isn't required where somebody is exhibiting or has characteristics of vulnerability. And interestingly, the FCA view is that firms need to move beyond complaints data as an indicator of outcomes for customers in vulnerable circumstances. So they need to gain a better insight and assurance on outcomes for customers than merely from what's apparent from complaints data. So this data could include, for example, application data, what are the dropout rates, customer support data, reissues that are coming up, etc.
Yeah, it's a very clear and true point in relation to incorporating dropout rates and slowness in responding to support tickets to reflect
Yeah,
the experience.
yeah.
How does all of these topics relate to quality assurance within an organization?
Okay, so what we have in Ireland is a consumer protection risk assessment model, and that's how the central bank um, addresses consumer protection. It issued, in terms of its analysis of regulated firms, it issued in 2017, and so we can expect to see modifications of it and expansions of various areas. But in terms of specific requirements of the CIPRA model, there's a requirement for firms to have oversight of and monitor complaints, consumer feedback and relevant distribution channels to assess whether product design is meeting customer needs. So as we've heard from Mazars, one of the specified UK consumer duty outcomes is that products and services are fit for purpose. QA is a specified area of both the sales areas and both post-sales modules of CIPRA. So there's a requirement that they be subject to regular quality assurance. And there's also correspondence from the CBI indicating an expectation that regular QA checks are in place throughout the product term, and specific checks conducted to ensure that systems and products are operating as they should. So in the UK consumer duty guidance, the FCA has indicated a regulatory expectation of proactivity. So what they want is the regulated firm to be proactive to ensure that their customer support options are actually working. So what they say is you monitor the support you provide, you take relevant feedback into account, you look for signs that might indicate your channel offering is not sufficient to meet the needs of your customers. And where this is the case, you should take reasonable steps to address any shortfall. So interestingly, they've given examples, the FCA have given examples of useful monitoring data, including first contact resolution rates, average time to resolution, speed to answer the telephone, average wait times, call abandon rates, email and digital channel speed to answer, customer call listening exercises, satisfaction surveys, and net promoter scores. Now, they've actually given additional examples. Those are just a sample of them. So that would be in the UK Consumer Duty Guidance document.
Yep. It's very clear. Once again, that's the great benefit of these regulations and guidelines, is that there's a great deal of clarity in what they're expecting organizations to do. They're not leaving it to interpretation. So one of the key topics, along with QA, which has really risen to the top in relation to how we are all experiencing the world of work, is AI. So Nora, AI is a huge live issue in terms of how we're engaging with customers, but what's the current regulatory picture around the use of AI in financial services?
Yes, it's a very live issue, very much in flux at the moment, as with a lot of areas involved in financial services regulatory law. There's a lot happening. So first of all, there's an EU Artificial Intelligence Act. When it's passed, it'll apply. It'll have direct effect in Ireland. It'll be by way of direct effect by way of regulation. It's been passed by the European Parliament, and it has to be passed by the Council, and it establishes a risk-based system in relation to the use of AI. So it deals with matters such as governance, risk management, disclosure framework for the use of high-risk AI systems, which include, for example, the use of creditworthiness scoring systems, and it prohibits the use of harmful systems. It's with a view to ensuring that those systems are safe in the EU and respect EU citizens' fundamental rights. So it's expected to come into force probably late this year and 2023, and have direct effect in Ireland 36 months later. There's also a proposed artificial intelligence liability directive. And what that does is it deals with liability arising from the use of AI systems. And interestingly, it places the onus on the owner of the AI system to prove that the AI system did not cause damage. So it's a rebuttable presumption there that it did, which is an interesting reversal of the usual burden of proof. And in Ireland, there's the National Artificial Intelligence Strategy, AI Here for Good. It launched in July 2021, a progress report issued on the 9th of August 2023, so very live. Its aims include staying open and adaptable to new innovations, also ensuring good governance, so to build both innovation and trust. And in the Irish Times of the 10th of August, the technology journalist Carolyn Lillington suggested that, as with GDPR, Ireland is likely to have international regulatory influence because so many tech multinationals will be regulated from here. So that's a sort of general picture. And then you asked about the impact of AI and financial services. So the CBI, in its recent update on the Innovation Hub, noted that many of the reg tech solutions that it's seeing in areas such as AML and counter-terrorist financing and fraud prevention have implemented AI. Now, in its submission to the CBI on the CPC review, the Irish Banking Culture Board asked a couple of questions. It was specific to banks, but I think it'll be relevant to all regulated firms that plan to use or do use AI systems. So what they wanted was clarity as to the expectations on banks relating to the ethical use of AI tools, so they don't encourage bias in excluding or negatively impacting some customers. Also, that they address information asymmetries, i.e. where the firm has more information than the customer, which will generally be the case, and also alternative support options for consumers who can't or choose not to use AI tools or systems. They also want clarity around how the central bank intends to supervise this area. So it's interesting because in the context of the use of AI, people are very focused on the AI specific legislation, but RegTech solution builders and regulation firms also need to be very aware that whatever they build using AI systems need to comply with the sector specific requirements relevant to the particular financial service. For example, credit worthiness. There are a number of requirements both in the Consumer Protection Code and in sector specific requirements such as the consumer credit regulations and the mortgage credit regulations dealing with this.
Yeah, it's a very simplistic comment to make, but we all know that regulators will be chasing AI for years to come. And it's definitely an area that organizations need to be aware of: the behavior of the firm, the behavior of the individual, but also the behavior of AI. Nora, in relation to this presentation, it's an extremely comprehensive treatment of customer engagement in financial services within Ireland. Can you give us a brief recap of what we've covered?
Sure. So what we've talked today is on the focus of the regulator in Ireland, primarily the central bank, similar, although not directly equivalent, to the UK consumer duty on achieving positive outcomes for customers. We've talked about the centrality of the Consumer Protection Code, that cross-sectoral code, the importance of the general principles, what acting in the best interest of consumers to seek to achieve positive outcomes for them means in actual terms, in terms of CX, and we can expect further regulatory developments on that. They're talking about focusing on the customer relationship through the customer's lens, keeping interests in balance, not making inappropriate gains by leveraging customer vulnerabilities, which is broadly regarded in this context to include issues such as inertia, the regulatory expectation relevant to specific customer engagement topics, including the effective informing of customers, the introduction of some positive friction in the customer journey while not constituting sludge practices, acceptable or unacceptable customer support practices, dealing with complaints and errors, interaction with consumers in vulnerable circumstances, and also the use of AI systems. Now, what we've not touched on, doubtless much to your relief, are regulatory expectations around the forthcoming individual accountability framework in Ireland, which will impose obligations on individuals. I should also mention that there's a raft of EU-derived regulations that apply in Ireland in terms of financial services. Some of them would have general application in terms of things like the distance marketing regulations. So they would apply across the board to financial services where the interaction is exclusively online, and non-compliance with some of those requirements can render the contract unenforceable. So it's very important to be aware of them. There's also other regulations in areas such as payment services, consumer credit, electronic money. We also, I think, to be honest, we've probably talked enough for one day about those sort of areas. But I guess in conclusion, it's really just to say that, as is clear from this webinar, there's so much going on. Regulation is really only going one way. And the earlier that firms meaningfully engage with the requirements, the better for them. It's a movable feast to some extent if firms feel strongly that regulatory expectations are simply unworkable, or don't take account of the real world. They should be engaging with their industry body, particularly in the current context, where there are discussion papers and feedback sought by the central bank in terms of its direction of travel on the Consumer Protection Code. And also, while firms must comply with their own duties, including their duties to shareholders, what is for sure is that tick box compliance or an excessively legalistic interpretation of the requirements will simply not cut it.
Excellent. Well, first of all, to the audience, thank you for your attention. There's a number of chapters within this presentation that you'll be able to return to that speak specifically to your area of interest. And Nora, many thanks for your comprehensive and detailed analysis. You didn't just write the book on the topic, you also presented it in a very clear and understandable way. So Nora, thank you very much. Audience, thank you very much. And we will be back with further series from Scorebuddy in the future.
Thank you all.